Okay, thank you very much, Simon. I appreciate it. Thank you for having me here today. I appreciate this opportunity to speak to everybody today. Thank you very much. Today, we're going to talk about trading the U.S. equity markets and how I've been able to successfully trade it for over 16 years. A little bit about myself. My name is Pete Renzulli. You can see on the bottom here, the website is tradingeducationblogs.com. On the bottom here, if you want to reach out for a little bit more than what we accomplished here today. Just a brief explanation of who I am, and just to give you a little background, I have been an entrepreneur, a small business owner for over 25 years. I have been trading for over 20 years. I originally started trading commodities and futures, and then made my way into full-time stock trading in 2000, actually, just after the internet bubble. I had my Series 24, which means that I had my licenses to manage other traders when I was in New York City. I also owned two successful proprietary trading firms. We had over 1,000 traders. Both of those companies were in New York City. And I actually had 9 offices at one time. We had offices in Amsterdam, in Canada, in Ireland. It was very exciting to see traders all over the world. There's a lot of hardworking people that really love to trade, and it was really nice to meet people around the country and around the world. Um, as you can see, I am also the CEO of 2 trading education firms. The Trading Education Blogs is the main one where I do stock trading education. As I said, I travel the world also teaching stock trading seminars. It's very exciting to travel the world and meet people. And to this day, I still do trading coaching and mentoring online, both in individual groups as well as individual coaching. So there's a picture of me in New York City, just to give you an idea so you can see who you're speaking to. This is at the New York Marriott. But more importantly, we're here to talk about trading. That was just to give you a little background of who I was. But I've personally traded millions of shares, hundreds of thousands of executions, and to be successful, there are certain things that always need to be in place. And there's really only 4 steps. And for some reason, we seem to want to make things more complicated than they need to be. I like to keep things simple. I like to keep them easy. And in my opinion, simple and easy makes it a much easier way to make money. So to succeed, your focus must be first and foremost on the steps and the mindset that go into producing high probability trades. Now, I can't emphasize it enough. This is the main goal. Entries and exits and all of that other kind of stuff, none of that matters if you don't have a good high probability trade. That comes first. Then there's the process of finding a good trade scenario. So everything that we're going to discuss now is all about this. Everything is focused on high probability trades. So number 1 is finding a good trade scenario, which means you find the institutional money, you find the big money. That's what I'm going to cover and show you how I do that today. Next is the mindset for managing each trade. You can have an absolutely terrific, perfect idea, but not manage it correctly. So number 2 is actually learning how to manage the trade itself. Number 3 is understanding probabilities. So if we go back up here, setting up probabilities is one part, but then understanding that every trade does not need to be successful for you to make money. So if you understand probabilities, you don't worry about every single trade. You think about a lot of trades over time, and that's how you become successful with trading. And then the proper mindset for managing yourself. You always want to be positive. You always want to have a good night's sleep. You always want to act like a professional. When you act like that, you have a very good chance of succeeding. So these are the 4 steps that we're going to cover today. And most importantly, I can't stress it enough. This is the most important part because managing the trade, managing yourself, nothing matters unless you have a good idea first. So that's what we're going to discuss here today. So this is actually what's going on in the market right now. And I thought it was important. This picture was taken roughly about an hour ago. And you can see that this is the SPY. So it's a picture of the market. There are certain opportunities that are really good opportunities to trade. And then there's certain opportunities that are really difficult to trade. So you can see here in the first window, and the second window. One of these opportunities is very simple. There's higher probabilities. And then in this window here, this is much more difficult. And in my experience with working in my own trading and with thousands of traders, far too many traders don't recognize when it's difficult and they lose money, and don't trade more when it's obvious. So our job as traders is to identify when institutions and big money are doing something obvious, and then to recognize when they're not doing something, so we should stay aside and save that money. So there's high probability trading there, and then there's difficult trading there. So you want to stay away from this stuff, and this is what you want to be involved with. So now actually what we have going on in the market here, we are now continuing to make new highs. The market's pulling back a little bit, but to set up a high probability trade right now, we're expecting follow through to the upside. So that's what we're looking at in the overall picture right now. But I can't stress enough, the more you do a good job of recognizing high probability trades and staying away from this kind of stuff, it will become much easier for you to be profitable. Okay? So, carrying that through, applying probabilities and developing the right mindset to find those kind of trades. So, here's what we're going to be doing. There are certain scenarios that simply have a higher probability and the potential for reward is greater. So our job as traders is to set up the probabilities so that we have greater reward. There are no trades that don't have any risk, but if we do a good job, the odds are in our favor to make money. So this means if we set up high probability trades, we should risk more to earn more because it's a good idea. And that's what we want to accomplish here together. So if you do not earn money on a trade that was high probability, it's still a good trading decision. Okay, I can't stress that enough. You can still lose money on good ideas, and that's the right thing you're supposed to do. So the question is, how do we determine probabilities? How do we set up high probability trades? So first and foremost, we're going to look at the market. We're going to look at the big picture in the market, and the terminology that we use is order flow. Order flow is what the big money is doing. Now, there's three different pieces to order flow that we need to look for. We look for the general market, we look for individual sectors, and then we look for stocks in individual sectors. So when all three of those are pointing in the same direction, that's when we have probability on our side. So we're building a foundation of order flow with the general market, sectors, and stocks all in the same direction, higher probability. Okay, so next level, where there's order flow only obvious in sectors or industries. So the market is not obvious, it's only these two. So it's still a higher probability, but not as strong as when you have this. So this is building a foundation. When you have a strong foundation of the market, the sector, and the stock, that's best case. That's good. That's higher probability. When there's no market, you work your way higher. You could still take those trades, but you don't have as much conviction from the big money. So when you look for ideas, you always start with the market. That's where you always start first. And then after that, as far as probabilities, if it's only the stock, it does not have the sector or the industry and does not have the market, it still has probability, but not as high. So when you have all three of these, that's the best trades. When you have order flow, the general market, the sectors, and the stocks. So I can't stress this enough. To be good, to make money, to be consistent, our whole job is to set up probability. So what I'm going to talk you through now is actually how to set up those probabilities. Okay? So what we need is we need a picture of price action that gives us this, that will show us exactly what we're supposed to look for in the market, in the sectors, and the stocks. So now we have a picture of price action, and before we get to the big picture, we need to know what's going on the small picture first. So I'm sure a lot of you are familiar with candlesticks, but I wanted to bring them out and show you how I look at them and then how those candlesticks become the price action that sets up high probability candles. So out of all of the possible candlestick pictures that you could look at, there's only 4 that I use, and hopefully by the end of this presentation you will be able to look at a chart and say, wow, that's all I need to look at. And that's what we're going to look at today. So whether a candle's green or whether a candle's red, where it is from the high and where it is to the low, they all mean something in the big picture, and I'm going to show you how I look at those, and hopefully you will do the same. So green candles that have that type of price action, they're bullish. And for those of you that don't know, bullish means you're expecting price to go higher, and bearish means we're expecting prices to go lower. So just to give you a quick rundown here, the candle is green because it opened here and closed there. That's what makes it green. The candle is red or bearish if it opened here and closed down there. So that's very important to set that characteristic. So how do we use that, and what candles are important? That's the single biggest thing that we're going to cover right now. And I hope by the time we're done, I have shown you a way that makes it look easy, and most important, you can apply it tomorrow and apply it the next time you look at charts. That's really one of the biggest things that I hope to give everybody today, is a simple way that works. So the first types of candles we're going to be looking at are what I call energy candles. Now, I need you to remember in your mind, energy means a lot of price action and a lot of volume. Okay? Now, bullish energy candlesticks have large bodies. That's the big thing there, large bodies, open near the low and close near the high. Bearish energy candlesticks are on the opposite side. But here's the biggest thing that I want you to remember. Energy means price action and volume, and that's what moves stocks. So our job as stock traders, we don't want to guess. We want to say, what does the big money do? And this is how you see it. And now what we're going to do is we're going to combine multiple candles, and it means the energy. Okay? So typically this represents a high energy move, and here's the key. This is what you want to write down. It means it's starting a move or ending a move. So it's stored up energy if it's starting a move, exhaustive energy if it's ending a move. That's the big thing we want to get across. So when you look at a candlestick chart or any stock that you look at, when you see this type of candle, it's going to start a move or end a move. So we don't guess, we just follow the big money. So the second type of candle is what we call a melted candle, and it is an entry signal or an exit signal. So it represents a potential reversal of the momentum. So a reversal of momentum means that's a spot to get in or a spot to get out. Okay? Melted candles are recognized, and here's the key, a small body. And this is one of the most powerful lessons that I could give you, and I'm going to show you on a chart in a minute. And this is important too. The color of the body is not important. This is what matters. A small body is a reversal of momentum. Now, what that means, though, is that this candle only matters if it's after momentum. And I'll show you what I mean by that in a minute. So the body near the high or the low can mean buyers or sellers were in charge despite the body size. Now, again, I want to keep coming back to this. Indecision is a small body. And if you think about why it's indecision, that means that price traded up, traded down, and then ended in the same spot. So that's why it's indecision. So what you're going to look for is melted candles to slow price action after at least 2 consecutive higher highs and lower lows. And I'm going to show you what that looks like on a chart in a minute. Okay? So the closer you get to 6 consecutive higher highs or lower lows, the more likely you will see a melted candle. Okay? So melted candles represent indecision. So this is what they all look like. They have either no body or a very small one. Okay? The color doesn't matter, but here's what matters. Small body represents indecision. That's the biggest thing that we need to pay attention to, because that's what ultimately becomes what you see on the charts. Okay? Now here's a chart of Citigroup. So you can see it's Citigroup here, and this is actually today's price action. And you can see the stock has not trended for the entire year. This is the beginning of January 2016. And look at all of the indecision almost the entire year and how often that is. So if you're looking at this stock and you see all of that indecision, that means the big money is not doing anything, so you do nothing. So this is very important. If you remember going all the way back to one of the first slides, easy money is when it's obvious. Easy money is when big money is doing something you can spot. And all year in this stock, indecision. So there's not a lot to do. So what does that mean? It means you do nothing. So when you look at a chart tomorrow, you look at a chart today, you are going to look to see if there is energy or indecision. That's the most important part. Energy, indecision. So the more energy you see, the more you trade, the more obvious it is. We are looking for big money to tell us it's okay to do something. So this is a good illustration of when to do nothing. And remember, doing nothing is smart. If it's not obvious, you keep money in your pocket. That's important. Okay? So the next one is the inside candlestick. And this is what it looks like. It's a candle that is completely inside the previous one. Now, this is important because when candlesticks form like this, volatility normally comes out of that. Okay, and I'm going to show you some really exciting setups from a daily chart in a second. So the current candle is completely inside of the previous one. So what's actually happening here is price action is pausing. Please write that down. It's very important. When price action pauses, you can expect like that, and I'll show you what I mean by that. So it's indecision or a pause. Now, what you want to remember here is indecisions are good entry signals. And this is another way of identifying an indecisive candle to look for it. So the correct play is to wait for a breakout from the inside candle. So I want you to write that down. An inside candle is an entry signal. And I want you to write down inside candles on daily candlesticks are your game plan, and then inside candlesticks on 5-minute, 10-minute, 15-minute charts are entry signals. Okay? So outside candlesticks are neutral, so you don't worry about that, but this is the key that you want to look at here. Typically an entry signal. And this is what we're going to show you. You can see this is a chart of V. Now, before I look at the inside candlestick, I hope that you could look at this chart right now and say energy, energy, right? Indecision, indecision. So you can tell if something is going on and if it's a day where something's obvious. Indecision, energy, indecision, indecision, right? Inside candle. So here's an inside candle set up on the daily chart. Now, what you look for in an inside candle is you look for this type of price action after that. So when you spot inside candle on the daily chart, you look to hold for breakouts. That's a really simple, really powerful trading signal on the daily candle. And now you can see here we have an inside candle yesterday and we have an inside candle today. So we have two inside candles where we'd expect another big move. So if we were trading together and I was working with you, this would be a very powerful setup because you have inside candle, and then you look for energy candle. So please write that down. When you have inside candle, you look for energy, energy, energy. Okay? Inside candle, energy, energy looking up. So very, very powerful, especially when you have more than one. Okay? All right, so more candlesticks telling a deeper story. And now what I want you to write down is well bid or well offered. Okay? And what happens with the closing price. But the lesson here is well bid and well offered. And what this tells us is using more than one candlestick Institutions are doing more. It gives us more conviction. It makes us more confident. It gives us higher probabilities. So this is yesterday's high. That's where it closed. That's the close and that's the high. There's the previous low and the new low. So right now we have higher lows and higher highs. So we have 1, 2, 3, 4 different price points there that help give us conviction. Okay. Now we also have this close is higher than the previous high. We have this close is higher than the previous close. You have 6 different reference points there that institutions from one day to the next are giving you conviction. This is high probability. So you have an energy candlestick, well bid, well bid. Okay, so what does this mean? Higher high, higher low, a close above the previous close, a close above the previous high. That is called well bid. So if you look at this and see it as a daily candlestick, a weekly candlestick, what that means is institutions are doing more of the same thing they did yesterday, and you can have conviction. And I will show you what this looks like on a daily chart. Now, on the opposite side, we have the previous close, the previous low, and then the next candle. So now immediately we have a whole bunch of reference points again to say 2 days in a row, institutions held prices down, institutions, big money, pushed prices lower. So it closed lower than the previous close, and it closed lower than the previous low. So in this instance, we have a whole different situation where sellers are doing something. So we have a lower high, a lower low, close, and pushing it lower. This one is called well offered. So what I want you to do now, write down well bid, means higher highs and higher lows, equals good to buy. That's what I want you to write down. Well offered, lower lows, lower highs, equals good to sell. Okay, can't stress that enough. So looking at that on charts, when 2 candlesticks form higher highs and a higher lows, that's considered well bid. Okay, this is caused by institutional demand. So remember, big money equals institutions. So we follow the big money. That makes it higher probability. So they're supporting higher prices. So we want to see the same. When 2 candlesticks form a lower high and a lower low, that is known as well offered. Okay, so what I'm giving you is simple, easy way to spot institutions. Okay, so it's caused by supply when it's well offered, caused by demand when you're looking for it to go higher. Okay, so if well bid or well offered and the last price is outside of the previous trading range, that's a plus. You would consider more leverage, and I'm going to show you what that means. Okay, so here's a stock of USO, the oil fund, and what we're going to take a look at is first well offered, and this is a daily chart. So this entire 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days in a row, this was well offered. So again, simple, easy, confident. You look at the chart and you say, is it lower high, lower low, lower high, lower low? When that happens, you be aggressive because you can be confident because that's what the big money is doing. So easy, simple, powerful. That's what we want to do. Keep it simple. Now, we also have well bid, right? And I'm sure you could spot that right now as well, looking at the price action that's happening right now. So we have well bid, higher high, higher low, right? Higher low, higher high. So you got 1, 2, 3, 4. And what is this? Inside candle. So we have good, well bid, buying pressure, indecision candle, right? So it's not only a melted candle, but it's also an inside candle. So what would that mean for you if you bought on the way higher, this means indecision. That means that you book profits. Okay, if it goes sideways, then you could look to get long again and be a buyer. But the most important point here is well offered, well bid, easy to spot, easy to understand. That is the big thing that I want to make sure. So if you're looking at a stock, you could look at it, continue to sell, continue to sell, continue to sell, easy. No fancy technical indicators, easy. That's what we want to do. So how do you use this with the big price action of what happens? So what we're going to learn how to do now is understand why a stock would start up here, go down here, go from here to go up here. We're going to add well bid and well offered in the big picture of price action. So now we're going to learn to read it like a pro and how to understand order flow and how that looks on a chart for institutional activity. So when we understand the big picture, it makes this help us out tremendous. Okay, so when you combine this with big picture, you learn to trade like a pro. That's what we want to get across here. Again, please write this down. Trading is simple. We don't need to make it complicated. So this is what we're going to be looking for in the perfect scenario. Now this is, please write this down. Heavy volume pause leads to a new uptrend. During the new uptrend, we look for light volume pause. So here's what you want to write down. Light volume pause, trend, heavy volume pause, reversal. And I'm going to show you what that looks like now. Okay, so the first area of price action that we're going to look for is known as accumulation. And it's where big money is buying stocks. So institutions and hedge funds are buying shares quietly as price moves lower. Now, this is the big part to remember here. Price is going down, but they're buying. That's what we want to learn here. Okay, so it's buying ending a downtrend, leading to a consolidation or a pullback. So the big money is buying. That's what you want to understand here. Okay, most traders are watching this stock and selling it because it's going down. Okay, so since the stock is going down, it's going to be easy for the big money to buy shares because they're still sellers. So what does this look like? Price is going down, it's going down, but the institutions are buying. That's what we want to get across. Okay, so what does this actually look like? When an institution has a large order, we want to try and follow them. So what they do is they try and buy it as quietly as possible. Now, why do they want to buy it as quietly as possible? That's the big thing, right? The reason for doing it quietly is simple. If they tip their hand or if they show you they have a lot of shares to buy, they will push the price up on themselves, and that is not what they want to do. Okay? So they will passively buy until selling dries up. If they need more, then they start to pay higher prices. So here's what's going on. Price is going down, and they're buying it. If there's no more selling, that's when prices start to turn higher. Okay? So it can be seen on a chart. Now, please write this down. This is the important part. On a chart, you will see a pause, which will be a consolidation or a pullback. This is the key. Heavier than normal volume after a downtrend. So here's what's going on. You have a downtrend, you have a pause, and then you have heavy volume. That's how you know big money is starting to buy. Okay, that's very important. As a matter of fact, if you take a look at a chart right now called FSLR, you will see that happening. Okay, so now, next what happens is institutions still need more, and now they have to buy actively. So we know this as the markup. The large buyer needs more shares. They still have the order to fill. So now they must start to pay higher prices in order to complete all of the shares that they need. So the pause that was formed by the big money stopped the stock from going down. So it's no longer selling. So now there's two groups of traders who need to buy stock. Traders who sold the stock short because it was going down, and now they're wrong, and the large buyer who needs more stock. So it's going down, going down, going down, and now it's starting to reverse to the upside. So the only logical thing that can happen is prices will start to go higher. Okay? So what we know is the markup, it's institutional demand, but you probably know that as the uptrend. That's what's important, okay? So demand eventually overtakes supply. Price action brings to breakout above the pause. Here's the key, large volume in the direction of the breakout. So let's go back to what we learned before. What will you see that will tell you this is happening? Energy candlesticks. Remember we said the big green candles with volume? That's what you're going to look for. So when you have a pause and large volume, that's energy candlestick starting a new move. That's important. That's why we covered that before. So the markup starts with larger green body energy candlesticks accompanied by significant volume. So price is going down, it goes sideways, and then it breaks up, and you see larger body candles. That's important. Okay? So an urgency to buy shares is now here. The markup is what we know as an uptrend. That's very important, but it's just as important to know why that happens. That's the important part, okay? So a markup with good order flow is higher highs, higher lows. Now this is what you want to write down. Light volume pauses. Light volume, you push up, pause. You push up, pause. That's the way to trade. And on the light volume pause, that means continuation. Okay? Now, what happens to end the uptrend? What happens if you look for prices to start to go down? So you have the large buyer filled the majority of their order, right? So prices were going down. It went sideways during this move, and now it started to go up. But now they're done. They filled the order. The markup will typically end, and here you go again. Please write this down, an increase in volume. So please write down heavy volume pause equals change of trend. That's what you want to write down, okay? So for this to be distribution and the end of the markup, there will be a heavy volume pause or a heavy volume fast move. And we talked about that before with energy candlesticks, right? So the large buyer is selling the end of their big order while prices are still going up. So as it's going up, the large buyer is selling. That's what you need to know. And you can see this all here with volume. Please write that down. Heavy volume turns it around. Heavy volume turns it higher. That's what you need to know. Okay? So after the markup, many shares are trading after the significant move. So many shares is heavy volume. That's what you need to write down. So it can be seen on a chart as a pause with heavier volume after an uptrend. So that's the three parts there, okay? Pause, heavy volume after an uptrend, okay? That's what you need to write down. Now, the last way is a huge spike in volatility. If it goes up really fast with heavy volume, you now know that as an energy candlestick with heavy volume that reverses it to the downside, okay? So what happens after that? Well, now prices start to trade down. Now you have selling by the big money. Big money now is not buying anymore. Now they're selling, and there's urgency to sell the stock. So at this phase, institutional buying has slowed down. The stock has no longer demand to support the higher prices. So now traders like me, like you, like Simon, we sense that the demand has exhausted itself. There is no more buying, no longer has demand, right? So now we look to short sell the stock and look for it to go down. Traders that bought late into the markup are now long and wrong. Okay, so those that are late must now sell their stock to exit their positions and this creates more selling urgency. So that's what we have now. So we went higher, we went sideways, and now we're starting to go down. Okay? So when the previous support levels are broken, two different people are selling. There's institutional selling and there's trading that's selling, and that has urgency to see prices move lower. Okay? So the markdown, what we know as a trend moving lower, starts with energy candlesticks, which are big red candles with volume, and we start to push lower. And now if we push lower and push lower on light volume pauses, that's when you expect follow through. So please write that down. Light volume pause equals follow through. Light volume pause equals continuation. So you expect it to follow through. Okay? So the price action structure that we just covered, so you can use it tomorrow. A markup or a markdown is what we know as the trend. But now you know why it happens. Big money causes the trend. We call that order flow. Okay? So what we're going to do now is make a distinction between the current order flow and the current trend. Okay? The trend will consist of momentum and light volume pauses. Now, we have big picture markup, big picture markdown, right? Momentum is well bid and well offered candlesticks, higher highs and higher lows, and then you have light volume pauses for follow through. So us as a trader, we will assume the order flow and the trend will continue unless you recognize heavier volume. So here's the key. Light volume, trend continues. Heavier volume, trend reverses. Please write that down. It is very simple, very important, and you can use that every single day. Keep trading simple. Simple trading makes you a smart trader. So I'm going to cover it one more time. Okay? You have a markup and a markdown, which is the trend. You assume the trend will continue if you have light volume. If you have heavy volume, you look for the trend to reverse. Okay, very simple. Volume during the pause will tell you the trend. Okay, very important. So heavy volume price action is the first clue for a potential change of trend. Okay, I've been using this for 16 years. Follow the big money, follow the price, follow the volume. It's simple, easy, and it works. Very easy to do. Okay? So price action is trend or pause. Please write that down. That is all we need to know. Simple is smart. Okay? So you're looking at a chart. What should you look for? If you want to say, I want to buy today or I want to sell, this is the first thing you ask. Are we trending or are we pausing? So are we going up or are we going sideways? Are we going down or are we going sideways? That is question number one. That is the first thing any chart you look at. Are buyers or sellers obvious? Okay. Next, a pause can be any type of consolidation pattern. We can go higher and sideways or higher and pull back, but it's a pause. That's what we're looking for. Okay. If order flow is present, that means you're trending up or trending down. Okay. You patiently wait for a pause before you get involved so you can manage risk. So here's the key. A pause is how you manage risk. So if we're trending, you wait for a consolidation, you wait for a pause. During the pause is your entry signal. Okay? So that pause is either a consolidation or a pullback. Volume during the pause will give you clues to the move after the pause. So what happens? You push up and you pause. You look for the volume. What are you looking for? Light volume during the pause equals trend continuation. So push up and pause, light volume, higher. Push up, pause, light volume, higher. Okay? Push up and pause, heavy volume, reverse. This is very important, very simple, very powerful, easy to use. You can use this today, tomorrow, forever. Very simple, and it works. Pause, light volume or heavy volume during a trend. Keep it simple, keep it powerful. Okay? So, what are we looking for when you look at a chart tomorrow? We're looking at a markup. Okay? Is there buying? Is it obvious? Please write this down. Is buying or selling obvious? That's the question number one. Okay? Within that markup or markdown, there is a pause or a consolidation. Now, there's three types of consolidations if it's obvious. Number one is accumulation. Now, do you remember what accumulation is? Okay. Accumulation means after a downtrend, it goes sideways on heavy volume. So institutions are buying after a downtrend and it goes sideways with heavy volume. Distribution is another type of pause where it goes higher, goes sideways, and heavy volume. And then number three is a continuation pause because it has light volume. That's the key there. So really, really simple, but powerful. So a consolidation that ends with a heavy volume breakout. All right. Volume in a consolidation or a flag gives clues to the next move. So this is the key here. You have a markup or a markdown. You have accumulation. What's accumulation? Heavy volume pause. What's distribution? Heavy volume pause. What's continuation? A light volume pause. That's all we need to know. We keep it simple. And the other one is when you move fast to the upside, fast to the downside, also heavy volume energy candlesticks. Okay, very important. I'm going to say it one more time. Please write down. Is buying or selling obvious? If yes, we look for light volume pause to get involved. Okay, so price action phase. This is the stock Home Depot, and this is a weekly chart. So what are we looking at? Buying is obvious. So if you start the day and you say, is buying obvious? Is selling obvious? In this, you say yes. Now, what happens here? If you remember what we said before, this is tough. This is difficult. This is where you lose money. Obvious, yes. Obvious, no. Okay, very important. This is where you make money. This is where you lose money. This is yes. This is no. Please write that down. You look at a chart tomorrow. Oh, and one thing, this is about 1 year to 18 months on a weekly chart. So you can look out and get a big picture of big money. Please write that down. Big picture of big money. Obvious yes, obvious no. Trade yes, trade no. Is it that simple? Yes. Now, I want to ask you a question. If this pause happens on heavy volume, what would we expect to happen next? So this is roughly a few weeks. So we go higher, pause, heavy volume, distribution starts to go down. What would we see here? Light volume. Okay? So tight consolidations are accumulation. Heavy, long consolidations are distribution. So next we have BA, long consolidation. Obvious, yes or no? No. No trade. Obvious, yes. Yes trade. Obvious, no, no trade. So please ask yourself the question, is buying or selling obvious? Keep trading simple. No, yes, no. Simple, powerful. Okay. Next one. JCP, you can see over a longer period of time, this is multiple years. Obvious, yes. Obvious, no. Obvious, yes. No, yes. No, yes. And what's this? Accumulation, right? We talked about that. Heavy volume after a downtrend. Accumulation, very powerful. Okay. And what is the markdown? Markdown is prices pushing lower, prices pushing lower. And that's it. That's what, thank you so much, Simon. If you want to learn a little bit more or get some education further than what I discussed today, I hope I made it very simple for you to understand. We follow the big money. That is our job. That is our only job. Okay, Simon, thank you very much. If we can take some questions, that would be terrific. Thank you so much for having me today, everybody. I really appreciate it. Thank you.